wonderful to be back, and I have yet to come here and have a bad weather day. So thank you for that. It helps with the hair. I thought I would start a little bit, talk a little bit about kind of the macro. I know you just heard a lot of the macro, but then I also wanted to dive into a few investment themes. Because tariffs or no tariffs, if you have long-term themes, they work. And it's my way of investing. So let's just start off by 2025 was always going to be a more challenging year. It was always going to be a slower growth year versus the last few that we've had. The last few years, we grew 3% plus in the economy. And a lot of that reason is because we put an enormous amount of fiscal policies in place, COVID and post-COVID, $7 trillion. I would argue that we had to put in a lot of fiscal and monetary policies during COVID, but we kind of overextended, which led to better growth, but it also led to higher inflation. Fast forward to 2025, this administration is different than the last administration. They're not all about fiscal policies putting into the economy. They're going to grow the economy differently. They're going to grow the economy via lower taxes and deregulation. So headed into 2025, I was always thinking we would be like 2% growth, 2.5%. By the way, that's above trend. Trend is 1.5%. So still good, but just not that 3% number that we had been seeing for a couple of years, and we got used to that. Along the way, we decided to focus on, or the administration decided to focus on tariffs, and we all expected tariffs. And that's what President Trump ran on. We didn't expect it to be as aggressive. That was a surprise, and it was a surprise to everyone. No one was thinking they were going to go after $700 billion per year in tariffs. So that kind of threw us all for a little bit of a loop. But eventually, once we get past tariffs, which we will focus on the other parts of the administration and their goals. And I think you will see growth stabilize and maybe even increase in the second half of the year. If we just took tariffs at face value, because we really don't know what's all going to happen, right? So let's just take all the tariffs that are out there. What does that actually mean to the economy? It's about 1.5% hit to GDP. It's about a 1% increase to inflation, which I'm not actually convinced about, because I think productivity is a really big part of our economy, and we're going to see that, and that'll help mitigate inflation. And it'll take about 3 to 5% off of corporate earnings. Now, let's just talk about corporate earnings for a minute, because that's really what I care about as a portfolio manager running equities, because my good friend Larry Kudlow taught me 18 years ago, stocks follow profits on the way up and on the way down. So we care what happens with profits. The last few years, we've seen double-digit earnings growth, which is really good. We actually just grew the first quarter earnings at 12%. Average is 5%. So we're doing pretty good. Are we going to see a slowdown because of tariffs? Yes, we are. But you're coming from a high base. You're not going to see negative earnings, in my opinion. And that's what's really the most important. So the economy overall, I think at 2%, maybe 1.5%, 2% is what I'm thinking. And it's going to be led by the consumer. And I know you just heard about that. And so I don't want to hone in too much on it, but the most important part to this economy is the consumer. It's 70% of GDP. So we root for the consumer. The labor market has been resilient. I know that you guys heard that the weekly jobless claims is something that I watch too, but it's very important. And it's a good read on the labor market, and I kind of smooth it out. I don't look on a week-to-week basis, neither should you, but on a kind of a 3-month, 6-month smoothing basis, you're running about 225,000 weekly jobless claims. During a recession, that number gets to 350 to 375,000. So we are nowhere near a recession on the labor front. And of course, we have 1.1 jobs available for one unemployed person. And when that happens, wage growth has actually been pretty decent, 3 to 4%. So the consumer has jobs, they have wage growth, and oh, by the way, inflation has come down. Yes, we peaked at 9%. Today we got a PPI number that was 2.4% year-over-year growth. That's the lowest level since COVID 2020. So we're making progress on inflation. I know we're complaining about egg prices. I get it. But nobody is complaining about gasoline prices being down 13% year over year. So the consumer, they have jobs, they have wages, lower inflation, and they are spending. Believe it or not, they're spending. We had the real spend number within the GDP report a couple of weeks ago. That was the highest since January of 2023. So the consumer is spending. And by the way, we are a nation of spenders. We just are. It's always been a really bad bet to bet against the consumer. Whether we have the money or not, we like to spend. Services has slowed down, but it's still very healthy. We get all kinds of data points and surveys and everything else, and not to complicate it all, but we've been in expansion on the services part of this economy for 4 years. So why do we care about services? Because it's 75% of consumption. So those are all the things that we're rooting for the consumer, and I think they're in pretty good shape. Sure, the lower end is not doing that well, and it's not all perfect, but it's like the 80-20 rule in terms of what's contributing the most from consumption and from the consumer. So that's a big part of why I think we're going to see 1.5–2% growth this year. The other piece, which is really, really big, and I'm going to get into it with my themes, but it's all about we're seeing a manufacturing renaissance here in the United States. A lot of that has to do with companies leaving China and building their supply chains around the world, diversifying, because they got so hurt during COVID. China was closed, it was open, it was closed, it was opened, it was a mess. And now you add on the Trump administration wanting to place tariffs on China aggressively to get more manufacturing here in the United States. But we're already seeing it, and we have been seeing it for several years. And I think that that's an interesting part also of the economy. It's only manufacturing is only 10% of the economy, but there's a multiplier effect. For every one job created in manufacturing, 7 jobs are created around it. So you really do root for these two pieces. All of this is to say not everything is perfect. I worry about a lot of things, and we can talk about that if you want. But I always worry. The market always climbs a wall of worry. And I worry when I don't worry, because that means you're complacent, right? So I always want to know what the other side is. And I got a laundry list of things that I worry about. But for the most part, I feel like we're in a good place in terms of the equity markets. And the markets actually agree with me because we're up 18% from the April lows. No one is ever going to be able to time the market. And by the way, last 2 years, we were up 20% plus. That's not normal. It feels good. No one really wanted to talk to me the last 2 years, but it's not normal. The average for the S&P 500, the average return over the last 50 years is 7.7%. In fixed income, it's 3%. So we just came off a really healthy growth, which felt good, but this year was a tougher setup. And markets didn't like the unknowns. We're chipping away at the unknowns, which is a good thing, which is why we're up 18% from the lows. But we're not out of the woods. But I do think that there's still a lot of value to be had here. And I would say I'm not a buyer of the European markets or the Chinese markets. They're up substantially. China's up 19% year to date. Europe's up 16% year to date. The S&P 500 is flat. So I think there's still places to invest. And that kind of brings me into some of my themes. Just want to make sure I'm on time. You're going to keep me on track, right? I can talk for hours. So let's just talk about a couple of themes. Because as I said, no matter what happens short term, if you believe in kind of the total addressable markets of various different themes, it's so powerful. And that's how I invest. I kind of think big picture, think where we are, I think of themes, and then I try to find companies that are exposed to those themes. So the first theme, and a lot of them don't change year to year, by the way. I mean, but these are really like decade-long themes. Cybersecurity. That is by far my favorite theme, which is sad to say, but it's going to be bigger than AI. It's because of AI, it's going to be bigger. So we have seen cybersecurity companies themselves get attacked. That's a sad state of affairs. But the problem is that there are so many companies. There are 4,000 cybersecurity companies in the world, public and private. None of them talk to each other. So that's the problem. But if you talk to a chief technology officer, which I do all the time, in fact, Hightower, I talk to him all the time. And he says to me, and many of the CTOs have said to me, they're spending in two places. They are spending on AI because they're trying to figure it all out. They don't really know what it means for their business. And they're also spending on cybersecurity because they can't afford to wake up and lose their business. So I think what you're going to, and by the way, he doesn't want to use 20 different vendors. Nobody does. They want to use like 5. So I think you're going to see massive consolidation in this industry. The top 5 players get bigger and bigger and bigger. And maybe it's 10 companies, whatever, but it's not going to be 4,000, that's for sure. And it's interesting because within my investment solutions team, we offer solutions like equities, fixed income, multi-asset, and also private markets. Second theme that I like a lot, and I kind of hit on it about onshoring and reshoring, but it really does have to do with, it starts with AI. If you believe in AI, which I do, I think you're in the early innings, then you need data centers. And we only have 11,000 data centers in the world. We're going to need to get to 20,000 by 2030. We have the most here in the States, 5,400. We're going to probably have to get to 10,000 if you believe in the demand. I believe in the demand. The hyperscalers are telling you that. They're going to spend $300 billion this year alone on AI. So how are we going to do with this? It's going to take a while. So you want to have exposure to data centers. Well, if you want to have exposure to data centers and you believe that we're going to need more of them, you need a grid. And this grid that we have, it's not good. We have not invested in the grid incrementally in 50 years. And Texas is even worse. And by the way, if you believe in EVs, you also need a grid. And you need a better grid. So that's a big theme. And then, of course, you need power for all of this stuff, and we're undersupplied in power. So that is a huge theme, and that is one of the reasons why I think you are going to continue to see massive build-outs here around the world, but that's a big theme. Onshoring, reshoring, supply chains moving around, and that actually benefits India, which is another theme. So you're seeing a lot of companies actually leave China to go around the world. A lot of them are going to India. 1.4 billion people in India, 40% of them are under 25 years old. Prime Minister Modi is laser focused on infrastructure. He's going to spend $1.7 trillion on infrastructure between now and 2030. That could be the 3rd largest nation in the world by 2030. Maybe even 1 or 2, we'll see. If you talk to any companies and I do a lot, they want to do more business in India, but they'll say that they can't because the ports aren't sophisticated enough and the capacity isn't there. So you're going to see massive build out, and infrastructure is a very big way to play it. I'm kind of an aviation country, I think, right? So that's a big theme for me. Another theme, housing. This is going to take a while because you need lower interest rates for sure. But I think we're eventually going to see lower interest rates. And I think if you got the 30-year fixed under 6%, you would see demand. We're 5 million homes short in this country. Home builders have underproduced for 15 consecutive years. They would rather buy back their stock than build, especially given inflation. So you have 5 million millennials that want to buy a home, first time. So I don't think necessarily you're going to see a boom in existing home sales, but I do think you're going to see interest and demand, should interest rates come down, from new home sales, from this cohort, the millennials. And we're seeing it when interest rates, they're all over the place, but when interest rates are down, mortgage applications are up. I mean, it's kind of obvious, but I do think that that's an interesting interesting theme. And then lastly, I would say this is my Peter Lynch hat. You know Peter Lynch, right? He was a very successful portfolio manager at Fidelity, probably just as good as Warren Buffett, dare I say it, but I believe that to be. And he used to say, buy what you know, buy what you see, buy what you're wearing. I look at my 18-year-old and I look at what she's doing, and I learn all the time. She's a better stock picker than I am. So the Peter Lynch in me says, animal health. I have 3 pets, and I spend more on them than my daughter. I do, really. But we're going to spend on animals, wealth, health and wealth, $150 billion a year between now and 2030. And there are really only 3 players in the industry. And so I think that industry is going to be, you're going to see massive consolidation from the fragmented companies as well. One last theme I didn't want to forget, because it's really important. It's investing in women. Women are going to inherit or come into $40 trillion of money over the next 25 years. And interesting, Margaret, if you talk to Ellevest, which I do, it's a women's boutique asset manager, 94% of women want a female advisor. Women are spending more than men in luxury goods, in homes. They're going to college at a faster rate than men. 31% of women last year bought themselves a diamond ring. I was one of them. Seriously, it's an interesting theme, and it's hard to play it, but you're seeing it in the private markets, not in the public markets. Something called femtech, and it is medical technology and innovation just for women. So think like osteoporosis or reproduction, that kind of thing. And there's really very few companies publicly that are able to capitalize on this. In fact, a lot of companies have gone bankrupt, but we're starting to see in the private market space this really perk up. And I think that that's something worth watching. Thank you very much for your time. Thanks for having me back.